Hi, folks. This is Big Mike Zlotnik, and today's discussion is going to be all about cost segregation and bonus depreciation. I'm going to dive into that and explain the benefits, the pros and cons, and so on and so forth. But before we do that, the usual disclaimer, this is for informational, educational purposes only. No advice of any kind, no solicitation of any kind. Consult with your attorney and CPA professional before making any investment decisions. So let's just talk a little bit about what is cost segregation. So cost segregation is an engineering study. Typically, there are cost segregation specialist companies that get engaged to conduct a study. Usually, it gets done on a commercial real estate property. May it be multifamily, may it be self-storage, industrial, shopping plaza, office, so on and so forth. So the cost segregation study typically gets done by actually engineers. They go to the property and then they start looking at the components of the property. They go through the property. Let's use an example of a multifamily for sake of simplicity. They go look at what multifamily property looks like. Could be multiple buildings, could be one large building, could be a high rise, or could be multiple garden style apartments. And they look at various components of the property. And let's just talk about components. So components are such as foundations, walls, roofs, electric, plumbing, doors, windows. Then inside the apartments, various components such as flooring, the bathrooms, kitchen, appliances, and so on and so forth. Different parts of the property have different depreciation schedules. So IRS allows for different depreciation schedules that is normal, typical, and common. Certain items have a long life and certain items have a short life. And IRS recognizes that and allows cost segregation process to segregate components that are depreciated on a long schedule. For example, on commercial real estate deals, foundation and walls will be depreciated on 39-year schedule. On a residential property, such as 1, 2, 3, or 4 door house, or duplex, triplex, or quad, it's typically 27 and a half years. So the long depreciation schedule is typically the worst case scenario. That's as long as you can depreciate. If you don't do cost segregation study, you can depreciate the property over 39 years of commercial property. But most investors would prefer faster depreciation schedules to get tax benefits earlier. So many items fall into 15-year schedule, 7-year, and 5-year schedules. These shorter depreciation schedules, there's certain IRS guidance and what items fall into what category. And these cost segregation companies and the engineers are specialists. They know IRS rules and they conduct a study. And as a result of a study, they basically put together a report that says, in this property, based on its acquisition price and its cost, this much is allocated to 5-year schedule. Next bucket is 7-year schedule. Next bucket is 15-year schedule. And finally, the rest is on, let's just say, 39-year schedule. That report goes to the CPAs. And the CPAs have the opportunity to do one of the two things. And typically, CPAs work in conjunction with owners. They can depreciate those items on those schedules, 5-year, 7, 15, for example. Or they have an ability to take bonus depreciation. So what is bonus depreciation? Bonus depreciation is essentially IRS allowed acceleration of these 5, 7, 15-year schedules to be taken in 1 year. The law was passed around 2017, if I remember correctly, that allows 100% bonus depreciation. The law has since started to phase out. So all the way from 2017 to 2022, and this needs to be double checked with the CPA. I'm just making a full disclaimer. I believe it was 5 full years of 100% bonus depreciation, but I'm not a CPA. I don't claim to be one. I don't play one on TV. It needs to be double checked with the CPA. But as far as I know, 2022 was 100% bonus depreciation year. Now 2023 depreciation is starting to schedule to phase out. So 2023 drops to 80% bonus depreciation. 2024 it becomes 60%, and then it continues to drop at about 20% per year reduction, unless the Congress renews or extends. So historically, bonus depreciation has been in the 50 to 100% level for many years, as there are both rich real estate Democrats and rich real estate Republicans. So on both sides of the aisle, there's interest and demand to extend bonus depreciation. So the assumption is that it is likely, not guaranteed, but likely, that the Congress will extend it in some form or shape when it starts phasing out over the next few years. So again, we're recording this in late July 2023. Bonus depreciation is at 80%. What does that mean? It means that you can take a 5-year schedule, you can bonus depreciate, but you can only take 80% of it this year, and then the rest has to go and be depreciated over the next 5 years. So that's generally how it works. Similarly for 7 years, similarly for 15 years. So bonus depreciation is a powerful tool to take a lot of tax deductions in the current year in the form of accelerated depreciation. And why folks need this? Why do they want cost segregation? And why do they want all this extra depreciation? Because it can save taxes. Essentially, it's a pseudo deduction that IRS allows. Depreciation is just a general definition. It's a pseudo deduction. It's not a real deduction, but it is for the purpose of the fact that there is a wear and tear on the items. And because there's wear and tear, these items are worth less over time, and that's why depreciation has a legitimate argument why the IRS code allows for this. So the bonus depreciation, as it appears, helps many investors, real estate professionals, and non-real estate professionals to take deductions against either other passive income. So depreciation is a passive loss. Accelerated depreciation is also a passive loss. So bonus depreciation is a form of accelerated depreciation. Comes as a passive loss, typically shows up on K1, Bucks 2, typically passive real estate gains and losses, typically reported on Bucks 2, and as a negative number, it's a loss. And that number can offset investments that generate positive number in Bucks 2. This is the normal, typical scenario that works for everyone, non-real estate professionals as well as real estate professionals. It's passive losses or can offset passive gains. I have a fancy term for this: pigs versus pals. Passive allocation losses are pals, and passive investment gains are pigs. And passive allocation losses, pals, offset tax liabilities from passive investment gains, pigs. So as funny as it sounds, that this is just CPA terminology, but in general, that's the concept. For real estate professionals, under some circumstances, they can use the deduction that comes to them in the form of depreciation as a passive loss to help offset other current income if they meet certain requirements, such as obviously 750 hours a year to be a real estate professional being their primary trade, as well as 500 hours typically spending on rental activities, managing and owning real estate portfolio of assets as a rental long-term type of activity, not a fix and flip, but more of a long-term holds. Anyway, these are the uses of depreciation depending on individual circumstances. Consult with your CPA and attorney professional. But the cost segregation and bonus depreciation is the mechanism how those large depreciation benefits pass to investors in the form of a loss in a K1 on a Bucks 2. I hope this helps for folks to understand how it works. It is a great benefit. In many ways, it allows folks for substantial amount of passive cash flow, quite often ability to defer gains and taxes for many years, as well as produce effectively losses that can actually carry forward. What's really interesting is, and again, consult with your CPA, some of his losses can actually go back to previous years, and some of the losses can carry forward if they're not used. So a lot of the benefits, a lot of possibilities. Consult with your CPA professional. Obviously, individual circumstances vary, but this is a very powerful benefit that is available for real estate investors. And the other question that has come up is, how do you choose whether you bonus depreciate something or not? For most syndications, and again, this works on partnerships, syndications, direct ownership. But most investors ask the question when they participate in syndication, whether he's a general partner, investors are limited partners. And typically, limited partners don't necessarily make a decision whether to bonus depreciate or not. Typically, the general partner does. But for most of the deals we've structured, we've done, most of the deals that I know, typically the general partner outlines their intention, outlines their objectives, and sometimes the estimates of what the depreciation will look like. Now, estimates are not guarantees, of course. Things can materially differ, but there is a good way to approximate or estimate what the depreciation benefits will be with a bonus depreciation built on top of a cost segregation study. So consult with your attorney, CPA professional. I hope this was helpful. Have a wonderful day. Thank you.